National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.
On today's show, end of the year tax planning 2011 with CPA Ken Davis.
And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals from Fountain Hills, Arizona, home of America's largest fountain. Of course, our decor today is all Christmas, and with me today is not only CPA Ken Davis, but CLU Ken Davis, CFP Ken Davis, ChFC Ken Davis. I mean, CLU, ChFC, CFP, and CPA. Oh my gosh. I mean, you are credentialed to the wall. You are the fiduciary. We're bowing to all of your letters behind your name, Ken.
Well, you know what the secret there is, Steve, is the fact is...
I know what the secret. You can take tests.
That's right. There you go. And a whole lot of the information flows from one to the other, so it looks great, but in fact, it's all pretty much the same.
Well, actually, as I said a couple days ago, you are the bridge, the ambassador between the CPA community and the financial advisory community, and especially us who are on the insurance side of that practice. You really seem to bridge the gap, and you're one of the few CPAs that understand us. I feel like I'm in a psychology room laying on a couch. Ken understands me. You know what I mean?
and quite frankly, it was a slow and painful process to give up the baggage. And in fact, you've heard me say this, I'm a recovering CPA, and I have to work at it daily. So
I have to say on the show, I've known Ken for over 20 years. I just want you to know that Ken did not come quietly to the dark side. I have to say, he did not come quietly. But we brought all the issues on. It was all built on regulation, taxation, legislation. We proved our point, not by salesmanship, but by the tactical issues of the code. And that's why Ken's on, because we feel some of the things we're going to talk about today in qualified plan land and retirement ideas have tax implications.
Well, and let me jump in there. I shake my head in amazement that my peers, the other CPAs, don't get it. I mean, just life insurance by itself, tax deferral, tax-free withdrawals, tax-free loans, tax-free death benefits. Oh my gosh, and pretty much no limits on contributions and no age 59 and a half penalties, none of that stuff. And I'm saying, why aren't these guys getting it? Why aren't they getting into it? And it takes a while, just like it did with me. It took me a while to slowly but surely get the message, and I'm a bit of an ambassador. I really like to show CPAs how to do this. In fact, I was just asked to do some continuing education for an attorney, an accountant, a banker, and a guy who works in the charitable giving area. And they want to know, they're anxious to know the inside skinny on how life insurance works and what doesn't.
Well, last year we went to the Thunderbird Global School of Management that was here in Scottsdale, and I have to tell you, they had so many really great workshops and seminars to attend, but the number 1 and 2 most attended seminars were non-modified endowment contracts, life insurance contracts, and captive insurance, which also deals with insurance. So, I mean, we're looking at 2 areas that were really hot among the wealthy, the affluent.
Well, think about the wealthy. They're the ones that the alternative minimum tax was designed for wealthy people that were trying to take big deductions. They're trying to pare it back. And the adjusted gross income limits on exemptions, credits, deductions, all this wonderful stuff that the more middle class, upper middle class get to use, these guys are out of the game. So they're looking for something, and you don't have to worry about deductions, exemptions, or credits when it doesn't even show up in your gross income. There's no 1099s on this stuff, so it never hits the system, so it never gets ferreted out.
Yeah, I mean, I'm just surprised at how many people don't know this. And I'm happy to say that I had a little piece of the pie when Ken was converted to our side of the dark side. I think I had a little bit to convince him.
Well, actually, to your credit, and I hate to admit it, but I had looked for somebody that could actually mentor me or tutor me into the insurance side of it. And you were the guy. You were the guy that, I was astounded. We sat there, and I'll never forget. You stood at a whiteboard and went through TEFRA, DEFRA guideline corridors, vital signs on the ratings, all this other stuff. And, my eyes are big, and now you're talking my language, detailed technical stuff. And I really hate to admit this. I went back to my drawer in my desk, and I opened it up, and there was the Internal Revenue Code. And I checked out everything you said, and I go, oh my God, the guy knows
Wow.
what he's talking about.
But still go to your CPA and tax attorney. Don't listen to Steve Savant. Listen, I have these, and we have crib sheets, and this is just one of our golden ones. And if you want these are absolutely free, produced by some of our top carriers. These are wonderful thumbnail sketches of the code. I have a 2-page report that we're going to kind of go off today on. And Ken, when we're talking about tax deductions, again, hey, we have to talk about qualified plans.
That's right.
We have to. And so when I'm looking at it, I just want to talk about my little arena for a second. Sorry to be so selfish here, but I noticed that the baby boomers, people over 50 and older, are getting a little bit of an advantage here because even in a simple IRA, right, where you have a regular maximum of $5,000, we're allowed, right, to actually put on another $1,000 under the catch-up provision, which has nothing to do with a condiment.
That's
but
for the
it's
regular
catching
IRAs,
up.
right? Mm-hmm.
Right, yeah, I'm looking at, so that's
And
just
the
a regular,
Roths.
and the Roth. And we're going to talk about that in a second. So
Yes,
I just
we are.
want to just make sure that, listen, if you are over 50 and you want to put an extra $1,000 on top of the $5,000 they're already given you, and of course, remember in 401ks, there's not too many left, but we still have employers that are matching some part of your 401k. You should be doing that all day long.
Mm-hmm.
I mean, always take advantage of a match, even if it's only 25, 50%.
Sure.
Always take advantage of it. Now, after that, maybe we have some other ideas.
That's right.
But I want to really encourage everyone, qualified plans that where the employer is playing and really supporting your participation in playing in a qualified plan, you should really try to go right there, dollar for dollar, try to match it up.
And we've said that for years, and it's pretty obvious. However, I don't think you necessarily should go beyond the match. And
No,
we'll
I
talk
agree with
about that in a few minutes.
Okay. Well, let's talk about
And it's $5,500 for 401k contributions for catch-up.
$5,500 for 401k.
Right.
Wow. So, if you're in a qualified plan, that could be significant.
Well, using the cheat sheet here too, 401k, 403b, that's pretty much your teachers, SARSEP, there's a few of those still around, and 457, which is your nonprofit or governmental unit. So,
Well, when I'm looking at all the deductions that you can do on qualified plans, I think it's really important because I don't see the government really helping us out anymore. I think you're on your own. You got to really think about your own retirement with your own nickel. I mean, I don't know if Social Security is going to be around or not. They're telling us now, remember, this is 10 years ago, when we were all in our late 40s, early 50s, they told us everything was cool and golden,
Sure.
and we were to depend on it, right?
Yep.
Now I hear new lines of demarcation being drawn that this Social Security, everybody 50, what is it, 50 or 55? I think it's something like 55. If you're 55 today or above the line, you're all right. Everybody below, these young people, they're not going to see a dime of this, or it's going to be so readjusted.
well, I think they would have a very hard time getting rid of it completely. However, I think actuarially it makes a whole lot of sense, numbers-wise, to push out the date that people can start drawing benefits. And I think they will. And I know mine somewhere around 66, 67 for full Social Security benefits. And quite frankly, I think a big part of the solution will have to be push it out to 70.
And think about this. I noticed that the difference in my Social Security of deferring to 70 is big number.
Yeah.
So if you don't need it, I'd say, hey, hold on, because age 70 may be able to be the place to play. Now, when we're talking about we were talking about basic deductions using IRAs. So I could put over 50 if you're under that, it's only 5,000. Over that, it's 6,000.
Right.
You said you can do a catch-up provision on a 401k if you're over 50 at what?
5,500
on top of the normal. What is
16.5.
16. So you could be 21.5 up.
All right.
Wow.
One caveat.
Yeah.
We technicians like our caveat. I don't like this caveat. The fact is that if you're a key employee, what they call a highly compensated employee, HCE or HICKey, they use that term. I've seen some pension administrators.
I got a CPA. I got a CPA using a sexual innuendo on the business insurance zone.
No. You use the sexual innuendo. I just said the HCE is called a hickey. That was your interpretation.
Okay. Well, I'm sorry, but I bet you if we do a survey right now, I want you to write me the biz at brokersalliance.com and tell me if it did not come to your mind first. Ken, I don't think I'm the only one here. Only a CPA with a pocket protector mentality.
Where is it? Oh, I left it at home.
What I mean? Only a number cruncher like you would actually do that. Okay.
Oh, here I've got a bin. Let's make
Wow.
this look official here.
Okay, so we have a
Okay,
hickey going on.
so-
Okay, what do I need to know about that?
Well, basically, they may be limited in their 401k withholding. And that's a wonderful opportunity for us as an insurance advisors to come back in for non-qualified
Well, let's talk about that
executive comp.
because I think that's huge. So I have some key people in corporations,
Yep.
in businesses
Yep.
that are key, and I say, wow, you really are highly compensated.
Right.
And there may be some rules. Oh, I can't take advantage of some of these 401k giveaways like the 5,500,
Yep.
or maybe it's scaled back depending upon how much I make.
I hear it all the time. The fact is, oh gosh, I made the contribution, was taken out of my paycheck, thought I was golden, and boom, at the year end, the pension administrators come in and say, oops, I'm sorry, you're a highly compensated employee, and here's your money back. And you go, what? I thought I was going to get a deduction.
And when the money comes back, it's taxed.
Well, sure.
Yeah. So I think this is another area to go down where you say, if you really can't, if you're restricted because of your highly compensation, your actual salary, your base comp, everything you're doing, if you're restricted, this is another area for a producer or a financial advisor to get involved.
Well, in fact, we're going to let's do a little plug for future shows. We're going to be talking about executive compensation, including Section 79 plans, which are primarily for the owners. We can talk about a 401k lookalike, and we can talk about an oldie but goodie, which is the double bonus 162. And I actually have a client right now with 85 employees that we're actually going to institute a Section 79 plan for the owner. He actually liked the double bonus for the key employee that was trying to put another 40 grand in his 401k. And then, of course, the rank and file get the 401k. And the fact of the matter is, and it depends upon the motivations of the employer, but they may actually want to adjust their matching contributions to free up some cash to take care of their key employees or themselves. So we're going to be talking about those things in another show, and that's a much broader topic than we can discuss in one day.
And we're going to get into all this in 2012. We're going to run through the gauntlet of all kinds of great ideas to supply you as our producers and financial advisors, because we really feel if we can arm you with the educational tools, which actually in turn become training and sales tools, you'll be armed with an arsenal of ideas to free up money and to look at as the client can then look to you as their fiduciary, their quarterback of their concerns.
That's correct.
Financial concerns. Well, when I'm looking at this list, this potpourri list, we just talked about the basics, the 401k. Now, when I'm looking at the big plans like SARP and some of these others, I'm sorry, the SARSEP, what numbers are there? What's the limitation on that?
Well, those are old plans, and there's not going to be a whole lot of people can do it. But to some extent, the rules have been consolidated so that a lot of the deductions for any kind of qualified plan kind of fall under the same things.
When we come back on this, we're going to talk about Roth IRA and even compare it to life insurance. I mean, I know it sounds heretical, but he's the CPA talking about it. I didn't say that. Okay.
I'm converted.
You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can email me at thebiz@brokersalliance.com or call me toll free 1-800-290-7226, extension 147. Ken and I will be right back from a word from our premier provider of guaranteed term and guaranteed UL, Legal and General America.
Banner Life Insurance Company and its subsidiary, William Penn Life Insurance Company of New York, comprise the Legal and General America companies, part of the International Legal and General Group, one of the largest insurance companies in the world. Now, Legal and General America is one of the top-rated insurance companies in America, with one of the strongest financial balance sheet among its peers. Legal and General America is a major player in guaranteed term and guaranteed universal life, and consistently ranks among the best carriers in almost every product spreadsheet. Legal and General America's product line of guaranteed universal life endows at the maturity date, while most carriers' cash values just zero out. You know the reputation of Banner? Now know the value of LGA, Legal and General America. The power to protect, the power to preserve, the power to serve their policyholders. That's Legal and General America.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and some people say, probably only me, interviewer extraordinaire. Remember, before moving forward with any of the strategies that we talk on this show, especially this week, always consult your CPA, tax attorney, and your broker-dealer compliance department. Hey, remember, You can call us 1-800-290-7226 for any of our strategies and products on life insurance, annuities, DI, LTC, and group pension plans. Hey, it's not what I know, it's who I know, and that's why I have Ken Davis on, CLU, ChFC, CFP, and CPA. Oh my gosh, I can't believe I all got it out of one mouth. And he said it, not me, super geek, pocket protector, number crunching, anal retentive. Oh my goodness.
Say all that. Look what I started. I opened myself up.
Well, you know, I have to say it. We don't get to punch a few fiduciaries around, but we're doing it today. I love that. I mean, I want people to be, we have to have people that are analytic. We have to have people that are detailed, number crunching. I just don't want to be that guy, right? Yeah. But yes, even I have my own.
I was born that way, so
you were born that way,
excuse.
and I actually had to work my way through there. The nuns did a great job. Okay, well, let's just talk about when we're talking about. I can't believe you're bringing this up, because I could bring this up and everybody would say, yes, that's Steve, the life insurance guy, 30 years in the business. Ken Davis says, hey, I want to talk to you today about Roth IRAs and life insurance in the same sentence. Oh, and I'm a CPA. I'm sorry, but that, to me, right, that's new to me. To have a person of your credentials and your long-standing relationship, especially the Arizona, you've spoken at the Arizona Society, you teach at it, you've been the former past president of the local chapter.
Right.
I mean, I'm just not used to guys like you, ambassador of goodwill, to speak to me about Roth IRAs and life insurance in the same sentence.
Well, you know, I'm actually on a bit of a mission in my own profession. I really want to get out there and I want to talk to CPAs and attorneys, whoever is in this area, and help them understand the tax benefits associated with life insurance. And the fact of the matter is, let's do a comparison. Let's go through what is a Roth IRA or a Roth 401k. Mm-hmm. I don't get a deduction up front, right? I get tax deferral in between. Mm-hmm. And then what do I get? If I wait until 59 and a half and I've had the Roth IRA in place for at least 5 years, I get to take my distributions out tax-free and without any 10% penalty. If I take it out before the 5-year rule and the age 59 and a half rule, I'm taxed on the earnings as ordinary income and a 10% penalty on the earnings. Mm-hmm. My original principal, since I never got a deduction, I have tax basis, comes back tax-free. What are some of the other issues there? Well, the contribution limitations. Okay, it's based on adjusted gross income, based on the 401k contribution rules. So I got limits. So we're back to the same thing with that highly compensated employee or the owner of the business being limited on what they can put in the 401ks, which are obviously much higher limits than the Roth IRA. So we got all these limits and penalties and all this stuff wrapped around it. So now let's shift over to what is a universal life policy. Now understand, it's a universal life policy that is designed to minimize the insurance, maximize the cash value so that we create higher cash values as quickly as we can for retirement purposes. And what do we get? No deduction up front, just like the Roth. Tax deferral, just like the Roth. We have to be careful on the back end. It isn't automatic. We have to manage it to make sure the policy doesn't blow up. But we can take tax-free withdrawals, okay? And what? Those distributions come out as withdrawals first, unless we treat them as a loan. And then the earnings we get to take out as loans. And if we're careful, if our agents work through us, we'll help them find the policies that are designed to do this and keep zero net cost loans.
Did you just say work through us?
Yeah.
So you're on our team now. The CPA's on my team. Okay, I like it.
That's right.
Well, think about it. When we're driving, a difference between should I do a Roth IRA or should I do a life insurance? My first thing is if you're doing 10 years or less, don't even come to the life insurance.
That's exactly right.
Just do the Roth IRA, be done with it.
Yep.
See how honest I can be and fair? But when I get out longer, and I think I'm going to be doing this for a little while, I think there's more advantages. And one of the big aspects of life insurance to me is, especially the way we construct it, we're always going to use the lowest non-modified endowment death benefit according to TAMRA. And we're going to make distributions under the force-out rule. We're going to do everything according to the regs to squeeze out the best internal rate of return. Now, when Ken said universal life, remember I have 3 different chassis to deal with, and another show will manage that, whether it's indexed, current assumption UL, or variable.
Sure.
And just a little heads up, a little side note, because I don't want to leave out whole life. We have one player right now that is a major player. If you're illustrating 7%, I have a whole life believe it or not, Ken, that's right there in the game, and their numbers are spectacular, and they were one of the few whole life carriers in 2011 that is not dropping their dividend for 2012. So just a little heads up.
Let's talk about that 10-year, because you and I are used to dealing with non-qualified types of ownership. And so we have to be very careful to manage that. However, think about it. If you got a 45-year-old person, right, they're going to have to wait till 59 and a half. That's almost 20 years, whereas we only have to wait, what, 10 years. So that's where the life insurance doesn't have the upfront limitations, has the tax deferral, tax-free withdrawals, tax-free loans, tax-free death benefit, and more liquidity. I would posit that a young person in their 20s, 30s, 40s, life insurance is a much, much better way to go than a traditional or a Roth IRA, because they have access to the cash much, much sooner. So, and it's that I don't have limitations on the contributions. I don't have the 59 and a half rule. I don't have the 5-year rule. I can get access to cash and put more in.
But are you arguing as a CPA that is a better deal for those young people because of the timeline issues?
It really depends upon the situation, as always, but generally I would say yes, the liquidity feature is a big bonus for the younger people.
Well, ladies and gentlemen, I've lived to see the day on the Business Insurance Zone in my 30-year career having a CPA sign off on life insurance over a Roth IRA.
And remember,
oh my gosh,
in our earlier discussion, we were talking about, by all means, if you've got a match, use the match.
Right, absolutely.
So if it's the first 3% of salary, 6% of salary, you know, if you're making $50,000 a year and you can put three. But if you have excess cash, stop there and take a look at the alternatives and see if that isn't a better choice because of the liquidity. And now, and honestly, Steve, we've seen the conversion from traditional whole life and term to universal life, where we unpacked it into separate pieces. I really think that adding the accelerated benefits for long-term care, terminal illness, and some of the serious illness stuff that we're seeing, and now even one of our carriers is offering a guaranteed income off a life insurance policy on an index product, and throwing indexing in there. I think the life insurance really becomes attractive.
Hey, do you want to throw that name out just so I can see if I can hit them up for some money?
Yeah, it's LSW.
Okay, LSW.
Life of the Southwest.
Okay, I like it. With an income rider on their indexed UL.
Yeah.
I love that. Okay. Well, Ken, when I'm thinking of, when we're looking at all these possibilities, qualified plans, again, anybody can order this sheet that we have.
Sure.
It's a nice digest. It only got a couple weeks ago before this sheet goes, antiquated.
Well, and if we want to get anal retentive here, if you put it back and front and have it laminated, stick it in your drawer, and you won't lose it, and it won't get all wrinkly and ripped and teared.
Yeah, it's not going to make my smartphone, because I can't make my smartphone the bigger font at my age now. So it's got to come in a nice plastic form.
You get one section of the thing on it.
Now, when I'm thinking about this, I'm looking at all the possibilities before the end of the year. But actually, when we're talking about qualified plans, some of this doesn't have to be December 31.
Well, that's a really interesting point. Is go to a third-party administration firm. I think you'll find most of them will allow you to fill out a questionnaire. They'll have the client sign the signature page. And I'm not sure how they do this, but I've always been told they can, even though the thing isn't finally formalized. I guess it's a verbal commitment, and then they have a signature page that makes it official. The qualified plan has to be put into place by year end, and of course work with your pension administrator, because they're the specialist side. That's their bailiwick. But you can do it before year end, and then you can actually make the contribution into next year.
But now, couldn't I take a regular IRA contribution, and if I don't have the money for it, I could wait till what? How long could I wait until the new year to write that check?
Well, it's the filing of your return, and I believe it's the extensions of the return. But the limits are only $5,000 for an IRA and $1,000 for people over 50. So whereas a qualified plan can be much higher.
I think sometimes some people will go ahead and try it. They'll say, I can't contribute to it December 31, but I could do it April 15th.
Sure. And
still get it in, and still get it for the year before.
Sure.
Yeah, or double dip. I like both sides of the year.
Or if we have one of our successful agents with that cash hanging around, he does a Section 179 deduction, creates a tax savings, use the tax savings, and then fund that qualified plan. So they get two deductions.
Now, when I'm thinking about the traditional Roth, a lot of people were trying to convert their traditional taxable IRAs with the deduction to the Roth. Is that pretty much over? Have we went through everybody that needs
Well,
to?
you know, the thing is, it's very complex and it's really hard, and there's all kinds of software, and we all thought it was going to be a big deal, and it kind of flopped on its face.
Oh my gosh, there were serious PR on this, and it went nowhere.
Well, think about it. One of the big issues is what? The taxation. First you have the distribution, you have to pay the tax. Well, where do you get the cash? Well, a lot of us have all our money tied up in the IRA, so then we have to distribute more, creating more taxable event to do it. So one of the critical things is having the cash on the side. One day I think I'm going to suggest that we have a show and we talk about funding a life insurance policy instead of a Roth, and we're going to have the same issue of tax, but then what can we do? We can actually loan against the
Policy
the
assets,
policy itself to pay the taxes, and with this arbitrage we have between being able to invest in the index at a higher rate and potentially have a lower cost of money, we can arbitrage it and actually pay for the taxes doing the loans. So
yeah, I love that. I love that. These are all ideas that we're trying to do to bring to our producers to free up money, to bring us to a new place where we can say, how am I going to fund these great ideas? Well, we're going to do it through tax planning at the end of the year. I mean, that's what we're doing. Remember, you can watch this show and all our shows in beautiful HD 1080p on our on-demand section right on our homepage. Just click on the red button at www.brokersalliance.com or hop out to our social networks, YouTube, Vimeo, Facebook, LinkedIn, and Twitter. This is Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.